Hey everybody, just thought I would get the weekend going, even though we probably don't have too many plans for the weekend other than staying in our house and binge watching Better Call Saul or something like that. But anyway, trying to do a lot more communication with clients right now. It's not because I'm panicking or anything like that, but this is a pretty tumultuous time. And I do realize that a lot of clients are nervous, and I'm getting a lot of the same questions from people kind of over and over. So I want to just get more information out to clients and other people too. There's going to be some people who aren't clients on this as well. So the big thing is if you have any questions, please use the little chat button. You can see that to the right of the screen. I'll try to answer questions as we go, but sometimes I'm moving back and forth between the slide presentation and the questions, so I may miss it until we get to the end. But really what I want to do today is go through a few things quickly for some clients who maybe didn't get to see some of the other presentations I sent, and then also give you ample time for questions and answers. So let me turn on the presentation. Okay, so I'm going to real quickly go through and do just a quick overview of the blizzard, winter, or ice age. And if you can't see my screen, just let me know. Hopefully everybody can. And then just talk about a little bit what I'm doing with clients' portfolios where we're managing the portfolios. Take a quick look at the new bailout provision, the CARES Act. And again, take some questions. So the big thing that I talked about for this downturn is it a blizzard? Is it a winter? Or are we talking an ice age here? And what I mean by that is just the duration of the event. So this is a graph of the volatility index. So this just shows you how volatile the markets have been, dating all the way back to the early 90s. And you can see there's two big spikes there. So one was in 2008, as you can imagine, and then one this year. So, it kind of, if you looked at this as sort of snowfall, let's say Denver, Colorado, you kind of look at it and say most of it's sort of in the, one standard deviation of each other. It's a pretty kind of tight window with two huge blizzards outside of that. So blizzard would just be something along the lines of what happened in 1987. So from August to October of 1987, the market dropped about 25%, but there was no recession, and the market essentially cleared the inefficiencies and then continued back up and got back to where it was within 2 years. Now, a typical bear market, which I consider a winter, so this is something that's going to last between 8 months to 2 years. And what you often see with this pattern is a very sharp drop followed by a sharp retracement. So, the bear market likes to inflict as much pain as it can on people. So what it does is it drops, people feel some pain, they sell, and then you have a retracement or a bounce up, sometimes violently up. And then people think, oh, it's over, I can get back in. And then the market kind of just does another slower, steady decline all the way to the bottom. That's your typical winter. And I always tell people, if it is a winter, if we're looking at something that's 8 months to 2 years, you can still take a sort of a long-term perspective. If you look at this chart, the blue is the up markets, the red are down markets. So outside of the 1929 crash, 1929 to 1932, really not too bad. You can kind of get a feeling that you're going to have a lot more upside than you do the downside. So if this is just a typical winter, yeah, it's not going to be fun, but we can get through that. But you can look at the far left, that screen with the Great Depression is not too pretty. And this just gives you a quick idea of some bear market recoveries. So in the middle right, you can see the August 1987 to August of 1989. Again, that's kind of the blizzard. Most of the others are just your typical winters, except for the September 1929 to November 1954. That's how long it actually took to get back to break even on an inflation-adjusted basis from the 1929 depression. So again, the big thing to remember is for winters, you do have a contraction in the GDP, but it's really not all that bad. This chart shows you going back to the late 70s for every recession. You can see even the worst ones, we had less than a 10% decline in gross domestic product, which is a measurement of the growth of the economy. Even in 2008, when the market lost 56% from top to bottom, the economy actually only contracted about 6 to 7%. Now, if you go back to the Great Depression, you actually saw a 25% decline. So probably one of the big things that's going to determine how bad this is going to be is how big of a decline are we actually going to get. Now, this one's been certainly sudden because you just have a forced shutdown in the economy in many aspects. So we are easily going to get to a 10% decline in GDP. And if it goes on for longer, if we're talking into June, even July, we're talking a 25% decline in GDP, more than likely. I mean, something that's going to rival the Great Depression. So what I'm doing with clients is I've always had metrics in place when I'm managing money for clients to protect on the downside. Usually what I'll use is what's called a 200-day moving average. So all you do is you take whatever position you're looking at, whether it's, this is a VTI, which is the Vanguard Total Stock Market Index. You take the 200-day moving average, which is the average closing price for the past 200 days. That's 200 trading days. So you're really talking about a year when you factor out weekends and holidays. And that's the red line here. If you look at the red line, you can kind of see what the 200-day moving average looks like. It's very steady. It's a very solid long-term trend. You're not doing a lot of trades with this, but it does give you a good idea of when to get out of the markets. It's kind of telling you, hey, when it breaks below that, we're breaking a long-term trend. So that's my usual way to do it. But right now, because I'm expecting tons and tons of volatility, both up, movements up and down, I'm going to shorten the window of when to get into stocks, when to get out of stocks to a 20-day moving average. So I'm bringing it way down as to what I'm looking at. And the 20-day moving average on this chart is the blue line. So you can see it moves a lot quicker than the red line, which represents a 200-day moving average. And in fact, the market current price is 123 for VTI, which is the Vanguard Total Stock Market. And the 20-day moving average is at 126. So we're really not too far away from a point where it would be kind of safe to get back in the water. So we could see us jump in. But I'm keeping that 20-day so that if it bounces above it, we get in. But if it bounces back below, we're going to get out. I'm not going to mess around. And the reason is, if this is an ice age, if this is something that rivals the Great Depression, and you cannot rule that out, you really can't, because like I said, we're easily going to get to a 10% contraction in GDP, and it could, without much effort, it could get to 15, 20%. And we can see the unemployment rate. Remember, the unemployment rate in 2008 got up to 10%. We're easily going to get to that. And in the Great Depression, it peaked at 25%. So if we go 2 or 3 more months, we could be looking at something like that. I just saw a statistic that there's 79 million people that are employed by small businesses. And most small businesses only have enough cash on hand right now to keep their current workforce to get them through the end of April. If they want to get to the end of May, they'd have to lay off at least 10% of their workforce. If they wanted to get through the end of June, they'd have to lay off 50%. So if this thing goes to June, you're talking 50% of 79 million people that could lose their job. Now, I know the government's stepping in with some bailouts, things along those lines to make it a little less painful, but still think about that for a second. that right there gets you to that Great Depression level. So we have to be cognizant that this could turn into something like that. And I'll give you some reasons why. But first, the reason I'm using that 20-day moving average is because even in the Great Depression, there were wild moves up and down. So you can see the initial trend down. The red line represents what happened between 29 and 32. So the initial move down, which we're really kind of tracing with this downturn. But you actually had a period near the end of 29 when the market bounced up pretty violently over a 5-month period, 30%. And in fact, if you go back to then, it wasn't like the crash happened in 29. They figured, hey, we're going to have a 10-year depression. They just thought it was kind of like we do. Hey, we'll have a big bounce back. We'll get the economy going again. Things will be fine. And you had a 30% move up, and everyone thought, well, okay, we got through it. But then it just started, punching people in the gut. Another drop, and then another bounce, a 17% drop or bounce. Drop more, 25% up. So you had some violent moves up. So I'm trying to use that 20-day moving average to make sure, one, we protect on any potential downsides. But also, if we do have some movements up, you're going to capture some of the equity upside. So hopefully, the goal is kind of get 85% of the upside and only 15% of the downside. Now, you're not going to get this thing perfect. It's impossible to do that. But we're going to just tighten up range. So if you've been a client with me for a while, you see there's not a ton of changes. I'd like to be a buy and hold, and I use that 200-day moving average to make sure I kind of focus a little bit longer term. But you're probably going to see a lot more trades right now just to be on the safe side. Another reason I think it could be possible that we have a more adverse market environment is the market, when we started this downturn, was extremely overvalued. In fact, by many measurements, it was more expensive than even the year 2000 and eclipsing 1929. So you had a very expensive market, a market that was priced to perfection. This shows several different methodologies of determining valuations of the stock market. And you can kind of see, as far as the historical percentile in the red, the far right, we were at least in the top 6% of every metric. Some of them were in the top 1%. So the market was already extremely high and due for some sort of pullback. The other reason I think that we could have a more prolonged market downturn, at the potential, I'm not saying it's going to happen, I'm saying we can't write it off, is we have just built up so much debt in the economy. This is a graph I've been showing all the way back to 2006, 2007. And what it basically shows is the total amount of debt as a percentage of our gross domestic product, or the size of the economy. So the first spike up there is actually 1930. That was the biggest spike up to that point when the U.S. debt hit 200% of our GDP. And at the peak in 2008, our economy got to 360% debt to GDP. So we just have a massive amount of debt. And why is debt bad? Well, debt actually starts off as something good. If you think about it from a personal finance standpoint, if you were to start to max out your credit cards, if you were spending more than you're making using credit cards, you're going to be able to increase your lifestyle. And then you're only going to be making a little bit more of a payment. And credit cards typically charge 2% of the balance on a monthly basis. So you can go quite a while spending more than you make and not have a problem. The issue comes when that balance, even that 2% payment, gets to be so big that you can't make it work. And then you don't have any good choices. You either just default on your debt, or you cut spending, or you're going to have to sell other items, maybe some of the things you bought, in order to make your payments. But all three of those aren't good for the economy overall when everybody's have this kind of debt level in aggregate. So that's why I'm a little nervous. This just shows you U.S. government debt relative to GDP. And we're at a point right now with this new bailout, we're going to be above the level that they had in World War II. And think about that. That's when essentially the U.S. government controlled the entire economy. We're still going to be higher than that. This one gives you domestic corporate debt relative to GDP. And again, so corporations are at all-time highs as well. So that's kind of the backdrop. I've got a presentation on savingyourselffromwallstreet.com, which is my blog, also at picketfencefinancial.com, which gets into more details on it. I just wanted to go over kind of briefly for clients who maybe haven't seen it, or other folks who aren't clients and haven't seen it yet either. So now I just want to spend a couple minutes talking about the new CARES Act, just to see if, give you a quick rundown on that. Okay, so I'm sure everybody's heard a little bit in the news about the new CARES Act. The thing you need to remember is the headline is the $1,200 per person or $2,400 for a married couple. That's getting all the news. The thing that I tell folks is it's not really just a check that's coming to you. It is a refundable tax credit from 2020. Refundable means even if your tax liability is zero, you're still going to get it. So ordinarily, a refundable credit, you don't get it until you actually file your tax return, like the education credit. So if you have a child in college, the education credit is refundable. So even if it zeroes out your tax liability and you still have some credit left, you still get it. So you can get more tax dollars than you actually paid in taxes or that you owe in taxes. So ordinarily, you do it when you file. So if it was a 2020 refundable credit, you wouldn't get it until you file your 2020 return in January, February, or March, or April of 2021. The government's just giving it to you sooner. Now, again, it's $1,200 per person or $2,400 for a married couple. If you have a child under the age of 17, you get an additional $500. So a lot of people think it's just if you have a dependent or a child who lives with you, college age, a child who's 18 or even 17, you think you would get the $500, but you don't. The reason is that's tied into the child tax credit, which phases out after the child turns age 17. Now, it is based on either your 2018 or 2019 tax return. So if you haven't filed your 2019 return yet, they'll use 2018. Now, if you don't file any return at all, let's say you're just on Social Security or you only have income that's so low that you don't have to file, well, they'll use your Social Security information to ensure that you get your refundable credit. They're also going to use the bank account on your tax return. So whatever bank account you used to get your refund, either in 18 or 19, that's what they'll use. Now, if you owed and you're not getting a refund or you didn't provide your bank information to the IRS, you can actually call them. It's 1-800-829-1040. You can call them. Just know that you're going to be on hold for a long time. So we talked about doing the binge watching of Better Call Saul. That's what you want to do, and just leave the phone on hold because you're going to be waiting a while. You're going to wait an hour even on a good day. So, with what's going on in the world, and I imagine they're fielding tons of calls with a more limited staff, you're probably looking at least a couple hours. So there is a phase out of the checks. And that phase out, you can see here, is based on your filing status. So married filing joint, you start to phase out at $150,000 of adjusted gross income, $112,500 for head of household. And if you're single or married filing separate, it's $75,000. And how's that work? Well, for every $100 of adjusted gross income amount above that, it reduces your credit by $5. So let's say you have a married couple making $170,000 of AGI. That means they've got $20,000 above the limit. So you divide that by 100, that gives you 200. Multiply by $5, that gives you 1,000 total. That's what they're going to lose. This chart gives you sort of an idea based on single, head of household, or married filing jointly, with anything from no kids up to 3 kids. You can see when it totally phases out. So for a single person with no children, you're going to be completely phased out of getting anything by the time you hit $100,000 of adjusted gross income. If you're married, filing joint, you'll be completely phased out of $200,000 if you have no children. If you have 3, you're going to be out about $225,000. Some other little provisions. So the headline has always been the checks, the $1,200, $2,400. But there's a lot of other good provisions in here to try to help you. The first one is dealing with your retirement plan. So if you're at the point you just need some cash, you don't know what to do, the government has provided some options to ensure that you can get to your 401k or IRA without too much of a problem. So they're allowing you to take out $100,000. So anybody before age 59 and a half, you had limits, like 50,000 was the limit on the 401k. And then for the IRA, it was really, in most cases, like 10,000. So that's without, getting into all kinds of different penalties. On that $100,000 limit, there's no 10% penalty assessed if you're under 59 and a half. There's also no mandatory tax withholding. So oftentimes when you take money from an IRA or 401k, they're going to withhold it at 20% rate for taxes. So they're not going to do that. They're going to put more money in your pocket that way. They're also allowing you to spread out the taxes over a 3-year period. So if you take out 100,000, you can split up, 33,000 for the next year, 2020, 21, 22. So that can help dampen the tax bite a little bit. Now, I do want to tell you that if this is a bad year for you and your income drops a lot because of this recession, you might still be better off doing the full taxes this year in hopes that in the ensuing 2 years, your income is going to go back up. The other nice thing is if you're taking this out and then you get back on your feet, your income improves, you can roll this thing back into your IRA or 401k, and you can do it over a 3-year period. So you could take some money now to get you through the tough times, and 2 or 3 years from now, you can still put the money back in, and there won't be any issues with it. The only issue would be that you would have to amend whatever tax return you filed with that withdrawal on there so you can get your tax dollars back. But that's it. The other nice thing is this year is they have waived the required minimum distribution for anybody who has to take that. So if you're past your 70 and a half and you're already taking your RMDs, you don't have to take it for this year. So you can leave your money in your IRA or 401k and let it continue to grow. That's great. That's fantastic. If you've already taken your RMD for the year, you can actually put it back into your IRA. If you're within the 60-day window, which is a typical rollover period, it's real easy. Just throw it back in. If you're past 60 days, so if you did it like right away in January, you still have 3 years to put it in, but it's probably going to require you to file an amended return to get your tax dollars back. That's the only bad side of that. Okay, some other things they did, they put on the tax return itself. The first one I really, really like. They have a $300 above the line charitable deduction. What does above the line mean? That basically means it's above your adjusted gross income. So if you look at your 1040, your tax return, you have at the top is all of your income sources. And then just below that is what they call adjustments to income. And then you get to adjusted gross income. The adjusted gross income is the key figure used in your tax return on almost every tax credit, every deduction. It's a huge number. So this is what they call above the line. So it's actually very good. And the reason they did that is right now, unless you itemize on your tax return, which only about 10% of Americans do due to the changes in the Trump tax law, they increased the standard deduction so much that most people now just take the standard deduction versus itemized. So most people can't write off their charitable deductions. Now you can. Now it's only $300, so it's not very big, but hey, it's something. I think it's great. I'd love to see this go up to a couple thousand, maybe 5,000, or maybe even a percentage of your income. That way, people who have paid off their mortgage, they can't itemize, they can do some charity and get a tax break for it. The other thing is they usually have a rule that you can only donate 60% of your adjusted gross income for deductions. They increased that to 100%. So you can now give 100% of your income to charity if you wanted to. And hey, you're a fantastic person if you're doing that. But I've never seen anybody give more than 60%. But it's there. That's a change they made. Some other little things is you can now deduct over-the-counter medications from an HSA or FSA account. So that's good. So instead of just prescriptions, you can now, if you have to get Tamiflu, if you have to get some zinc, to help you out with preventative measures, all that good stuff, you can write that off. Medicare recipients will get a free vaccine once it's available, of course, for the COVID-19. Medicare folks can also get a 90-day supply of prescriptions. This is to try to keep people from going out too much into public, so they can get up to 90 days. And they've also now made telehealth a deductible expense. It wasn't before. Also education. So they did things for folks with student loans or who are in college. So they're basically allowing people to defer all student loan payments until September 30th. Now, it's not automatic. It's not something that's going to happen unless you call up your provider and request this deferment. But it is an opportunity for you not to have to pay your student loans without any penalty for a few months. If you are participating in a loan forgiveness program, so if you're a teacher or you work in the nonprofit sector or not for-profit sector, and you're in the process of the 10-year process to get your loans forgiven, this is a no-brainer because they're not going to penalize you. They're not going to extend that 10-year window that you have to satisfy to get your loans forgiven. So this is a freebie for you. So if you're in one of those programs, you definitely want to call your provider and get this deferment, because that you'll never have to repay it back. Another nice thing is if you are in default, all the involuntary debt collections are waived until September 30. So if they're garnishing your wages, if they're assessing your bank account, or if they're keeping a tax refund to pay for your defaulted student loans, they're not going to do that until September 30th. If you're an active student and your school closed or you had to leave because you were affected by the coronavirus, if you had a Pell Grant or if you took a direct loan from the government, you do not have to pay that back. So that's another little benefit there. Unemployment. This is probably the best thing that they put in the plan. I really think the $1,200, $2,400 check, I think it's a waste of money because so many people don't need it. And it's going to take a long time to get there. This is what needs to be done. If you lose your job, we should be helping people become unemployed. So what's unique about this is the first time they put a provision in there that business owners can get unemployment insurance. They've never had that before. Unemployed or solo entrepreneurs, 1099 folks, and business owners don't pay into the state unemployment insurance for themselves. So being able to access this is really, really unique. The other thing the federal government's doing is they're adding a $600 per week income to the unemployment. And that's fantastic when you figure the average state unemployment weekly check is only about $400. So this is going to take it from an average of $400 up to $1,000. And the other thing is there's no waiting period. Usually you have to wait a full week before unemployment kicks in. As soon as you file now, you're going to get unemployment. And finally, they're going to give you an extra 13 weeks of unemployment. So that's going to extend a whole nother quarter for you to help you get back on your feet. So I think that's fantastic. We'll do some questions and answers here. But I do want to say that I'm pretty active in getting some videos out there. I have some podcasts, it's basically like a radio show you can listen to on your phone at your convenience whenever you want. You can get that at savingyourselffromwallstreet.com. You can find me on Twitter, just Kurt Kinder. Facebook is Saving Yourself from Wall Street or Picket Fence Financial. All this stuff's going to be on there. I'm going to try to do this every week right now, at least until we get through things. But if you do have any questions, that's the big reason I want to do this. In case someone has questions, I'm happy to answer it. So if you do have any questions, if anything's popping into your head, just let me know. I don't see any questions right now, but if there are, this is your last chance. Otherwise, you can get to binge watching your favorite show. I actually started watching Ozark. I like it because I was shocked. It's about a financial planner who ends up getting involved with the mob. I would never do that, but it's interesting. Can we apply if we're 1099 employee? Yes, for the unemployment insurance is what I'm assuming that the question is. So yeah, if you're a 1099 employee, let's say you're an Uber driver or you're a consultant or you just do part-time jobs, you're going to be eligible for unemployment insurance. what you'd have to do when you file for unemployment is you're going to have to basically show what your income level is, and that will be what determines the amount of money that you'll get for your benefit. But it is new, and you can do it. Okay. What are some of the indicators you look for that the market has bottomed out? Well, it's interesting. So I use those technical indicators a lot. It gives you a trend, market relative to trends. That's probably the biggest thing. I always say that technical indicators are kind of like a baby, right? When you have a child, that child is communicating with you. Now, it's not a language that you understand, but it is telling you what it wants. So if it's crying, you check the diaper. Are they wet? If that's not it, okay, are they hungry? If that's not it, let's check their fever, all that good stuff. Same thing with the market is telling you, hey, this is a trend we're breaking. You need to pay attention to it. That's always the first thing. The other thing that you want to look at, that I look at, is sentiment. So usually it's one of those, you want to be doing the opposite of what everyone else is. So when everyone else is bullish, like they were in January, bullishness was at all-time highs. That's typically when you kind of want to be on the other side. And then pessimism. The bottom in 2009, it was the highest pessimism rating ever. And right now, we're not there. We're not at the highest pessimism. In fact, consumer confidence is still pretty high relative to what you would think it would be. So that's another big thing, a metric I watch, is just pessimism. So those are a couple of the little things, but I really focus on the technical indicators. Just because a lot of the other ones are more a little touchy-feely, but this thing it's telling you, hey, we're moving in a direction with or without the market. Okay. I've got a question here about dependents and getting the check, the $1,200 check. So that's a tricky one. If you have them file by themselves, they'll probably get the $1,200 check. So for 2019, you want to check and see if it's going to benefit them to file on their own for tax purposes. If they could get that $1,200 and you're not going to save $1,200 by claiming a child, like somebody who's in college, you probably want them to take their own standard deduction so that they can get the $1,200 check. So that's definitely something you want to look at. And the other thing to remember too is, let's say you file the taxes and it didn't get in there in time to get the $1,200, it all comes out on your 2020 return. So if your dependent ends up just not being a dependent this year, claims himself, and you think he would get the $1,200 but doesn't, well, when he files next year, his 2020 return, that's when he'll get his $1,200. So it all comes out in the wash. Let's see, any other questions? Anything else? Okay, I think that's it. Seems to be all we've got. So there'll be a replay of this so you can watch it again if you weren't bored enough the first time. But I really appreciate coming in, and we're going to try to get a lot of information out to you. Try to do these morning coffees, and just relax and go through a few things, because we're going to be moving a lot. Like if we bounce up a couple percent, we're probably going to get back in the market. So maybe we'll talk about that next week. Or who knows? The market might be dropping more. We never know. So again, thanks so much. If you have any other questions that I didn't get here, feel free to email me or reach out on Twitter or Facebook. Take care.